What is going on, Internet? Eric Bandholz back again with another e-commerce conversations. I hope all is well on the other side of the Internet. On the other side of the Internet from me, Frank. What's up, man?
How we doing, Eric? Thanks for having me.
Doing well. We're both in some nice warm weather areas, I guess, here in January.
That is right.
Who the heck are you, and what the heck do you do?
Yeah, the elevator pitch on me is my name is Frank Kosarek. Currently, I'm the co-founder of a company called BizPort, where we are a modern business marketplace to help founders exit their brands. I lead the e-commerce vertical of buyers and sellers for BizPort. And prior to being here, I was head of M&A and employee number one at a company called Open Store here in Miami, where I bought 50 Shopify brands and saw a lot of transactions and a lot of things to avoid, for potential founders who might want to exit.
Yeah, that's we'll talk a little bit M&A and kind of like get a feel for what's going on there. 50 deals in a pretty short period of time. I imagine you've seen a lot of different functions. What are kind of like, if I'm an e-commerce operator, what are some of the best practices if I'm trying to build my business to sell?
Yeah. So I think, Eric, to answer that question, I like to start off with the framework for how e-commerce businesses are valued. There's a metric in the industry called seller's discretionary earnings, which is the basis for everything. So I'll break that down. SDE, or seller's discretionary earnings, is the sum of the business's net income, let's say annually, what you would put on a tax return, and then also any officer salary or benefits, and then finally any one-time expenses. So to put kind of round numbers on the problem, let's assume a business makes $250,000 of net income annually. The founder pays themselves $100,000. They have $40,000 of healthcare expense, and they had a one-time legal fee of $10,000, something like that. So the SDE figure is that $250K of net income plus the owner's salary of $100K plus the benefits of $40K, and then also the one-time legal expense of the additional $50K. So that would put everything at it's called $400K of seller's discretionary earnings, and then that number is the basis of a multiple that's usually anywhere from 2.5 times, 2 times to 2.5 times, up to 5 times for like a category leading brand at huge scale. So I think that is the first 101 metric to pay attention to. And then the most basic piece of advice with respect to that is track that number, right? So every month, if you're an e-com owner, the first thing you can do is say, okay, what was my business's true net income? What were all of the added back type expenses? And then for that month, what's my seller's discretionary earnings? That will give you a great baseline to kind of monitor how your business is growing and how your valuation might be changing over time.
Man, I've always heard 3 to 5, but you're the first time I've heard 2 to 2.5 to 5. Like, has it gotten pretty rough out there for e-com sellers? Is the demand not out there anymore?
I think, we all saw in 2020 the basically decades worth of growth that e-commerce had in roughly 1 year, mostly due to, COVID upending how we shop. I think back then the multiples crept up a little bit higher, and a lot of e-commerce businesses were founded that probably shouldn't have been founded, right? They didn't have a reliable customer base or a real product market fit equation. I think what's changed is, aggregators, a lot of aggregators have sort of pulled back their strategies, which means that the options for folks to easily walk away from their brand overnight, that's changing. And I think acquirers are being more selective about the types of brands they buy. In practice, the way that looks is the top performing e-com brands when it comes to exit look more like subscription type businesses, right? They're not, I buy a kid's trike one time for $300 and then I never come back to that site again. And that's the end of the the journey. It's like a men's skincare brand or supplements brand where maybe I can subscribe and save. And the math I'm doing is how can I get the max customer value out of each subscriber, assuming that I'm only paying to acquire them one time, right? So I would say that's why there are some brands in the lower end that don't have that characteristic that might see leaner valuations, but then that upper end of 5 times is for a great subscription heavy brand.
Okay. So let's talk a little bit more about the deal flow. If you're building a business, where is most of the volume happening, or the kind of like the easiest um, revenue hurdle to start selling your business? So is it easier for a $1
Yeah.
million brand or a
Mhm,
$10
mhm.
million brand, $100 million brand? What do you see?
Yeah, I'll answer that in a couple of parts. So I would say at BizPort, the way we think about it is that $1 million sales threshold annually is a minimum that we like to see to get involved with a brand. And that's usually because e-commerce margins work out to where there would be enough cash flow minimum to underwrite maybe with a loan or some balance sheet capital as needed. So that's where we get involved, at least on the advisory side. Another piece I'll add is scale is a huge input to how an e-commerce business is valued. And what I mean by that is the multiple of discretionary earnings that I talked about earlier on this call. That applies for brands doing, I would say, maybe up to 15 or 20 million of revenue, probably on the high end. When you start seeing consumer brands doing 30, 40, 50 on up million in revenue, the buyer demographic changes. You might have a consumer private equity group interested, or a larger strategic, and those types of acquirers are more likely to pay revenue multiples. So there is a dividing line that isn't like a hard line in the sand, but it's something to be aware of.
And what would you say? So let's say you build to a $50 million company. We're now talking into the revenue multiples. What kind of valuations are you looking at for that?
Yeah, I think I've seen 1.5 times, 2 times revenue in some cases. I think that is there's less of an established market because there are fewer deals at that revenue scale. Um, but the way an acquirer would look at, let's say, a $50 million revenue business is more, how do I acquire market share? Right. This men's personal care brand has 1% of the U.S. market or something, and that is the justification for a revenue multiple. Whereas a much smaller brand, you're actually underwriting cash flow, right? And so you're going to look at that bottom line number a lot more carefully.
I would kind of like add into here, or at least my take. I've never, as someone who's never successfully sold a business, take my advice with a grain of salt. But
Sure, sure.
like if you've grown your business to a large enough point, and people are probably well aware of this. Let's say you're selling to a public company. Let's say we sell to L'Oreal
Hmm.
or Unilever or Edgewell. If you go to their stock ticker, you will see their price per earnings. So let's say their price per earnings is like a 20.
Hmm.
And what that's basically saying is their company is worth 20 times what they're making in revenue.
Correct. Exactly.
So by default, if they acquire a company for, you know, whatever that revenue is, let's say you're doing $50 million a year, then I would expect to start the negotiation at whatever their PDE is, because they're effectively getting any margin by buying you for less than their PDE
Hmm.
for
Yeah.
what it is in the public markets.
Yep.
Kind of like understanding that as a starting point for major public companies is probably going to be wise. And
Right.
then I would imagine maybe at that 30 to 50 million, you're kind of dealing with like private equity where they're looking to quickly ramp you up a little bit and then selling you to the larger players. Because
Yeah.
at a certain point, it just feels like these mega brands, like they just don't want to mess around with someone doing $10 million or $20 million
True.
a year. It's just not worth the headache.
Yeah, it's true. And the one thing I would add to your equation about P to E is that bottom line number E is earnings, right? So that is a profit number,
Oh,
uh,
right.
and so 20 times earnings might be some smaller multiple of revenue. given the margin profile of a business like that. But you're right. I think it's kind of a law of large numbers where if I'm a $100 million market cap brand, I'm probably not going to want to underwrite a small personal care brand doing 500K of discretionary earnings. I'm probably going to look for something doing 5 million, 10 million minimum to justify the brain damage of getting that brand integrated.
Yeah, and I mean, the other thing is like we all, as we work on our businesses, they're all our babies, so we have this special attachment to it. Tell me some stories of like owners who just can't seem to separate their internal worth for what the business is and what a fair market price is, and how do you
hmm
negotiate that?
hmm So, I think M&A, especially for small e-commerce brands, is very much an art and not a science. So there's no like one size fits all type deal structure here. And whatever you can bridge between seller and buyer in terms of valuation is what actually gets a deal done. So across the board, I think the vast majority, if not every e-commerce founder out there, has a very high valuation expectation for what their brand is worth. Usually large multiples of revenue that I've seen. I think that's partially because there's so much work that goes into building a brand from the ground up that an outside acquirer couldn't appreciate from a P&L, right? Like it's intangible. That's one input. And then the other is, I don't think it's commonly known that brands are valued on a multiple of discretionary earnings, not top line, below a certain scale. So I think that's, there's always a bit of a reality check. And I think another really important input is a buyer who is valuing a true brand with brand equity, distribution potential, upside potential. You won't be able to fully recognize that looking backwards at an income statement, right, from the last 3 years. So there are intangibles that a buyer probably is not able or willing to value completely with cash down. So something we see a lot is two structures. One is called a seller note, and the other is called a seller earnout. And so these two instruments can kind of bridge the gap between what a buyer is comfortable paying and what a seller is comfortable exiting for. You can think of a seller note as me giving you an implicit loan. So I might say, Eric, I'm the seller of a business. I'm asking $1 million for it. You say, Frank, I can't pay you $1 million up front, but I'll give you 700K down. And then I'll pay you 300K with some interest over the next 36 months, right? So I'm not giving you a loan, so to speak, but I'm letting you repay some portion of the purchase price over time, and that gives you some skin in the game as well as me. The other structure we see is, let's say you say, hey, Frank, I think this brand should be worth $2 million within 12 months from now. So I can't accept I can't accept $1 million for a brand I'm selling. I might say back to you, okay, fantastic. I'll pay you $1 million down now. And then depending on how the brand performs over the next 12 months, you can unlock another $1 million of payout, if not more than that, right? So it's a performance-based earnout. And those two structures, I would say more often than not, I see them in almost every transaction we've looked at, and they help, basically bridge this valuation gap that always exists between seller and buyer.
Yeah, I mean, maybe because our business is bootstrapped and not loaded up with debt and a whole bunch of third-party investors. Like, if I ever made the decision to sell it, I would just want to walk away from it. Like, I would probably, me personally, accept less money to just be done with it. Like, I can't have this. It almost feels like you have one foot in and one foot out for a
Correct.
period of time, and you're not really able to move on to the next thing. Are there, you've done 50 deals. Like, how many of those deals realistically ended up with the seller not really hitting those numbers and not really getting the payout that they thought they would get?
So at OpenStore, we didn't use earnouts or seller notes. It made it difficult sometimes to do deals. I would say outside of OpenStore, I would say, lion's share of deals will have some form of earnout or seller note, probably 75% plus. I think another important point you just brought up is, I might want to walk away from the brand forever and just like wash my hands and go on to the next thing. Um, I would say there's some sellers like that out there. A smart buyer will probably negotiate some transition period for you, whereby you spend 3 to 6 months transitioning the operations to the buyer. And if needed, if they need more time than that, they might put you on a consulting agreement where they pay you some monthly stipend to be kind of like an advisor, so to speak. But that would get you fully out of the brand, like your equity. You don't have variable upside there. I think it's very common that you know a buyer would ask you to stick around in some capacity.
Yeah, I mean, I think like being a point of contact or giving some expertise here and there, but not running the company. Because I feel
Exactly.
like once you're as a entrepreneur, you've been running this business based on your own decisions for whatever period of time it is.
Right.
All of a sudden, you have a new owner, so no longer are you. I mean, you could always make the argument that, if you're running the company, you're still kind of in charge. But the reality is, like, once you sell the company, you've sold the company. So you
Right.
don't own it anymore. And
Right.
and it's the responsibility of the owner to, make sure that it does well or doesn't do well. So yeah, I think like some kind of advisory position where they pay you a salary or, that makes sense. But if they're giving you a performance and you really don't have the ability to pull the strings anymore, that would be a huge
Oh,
thing to look out for in the
yeah,
deal, in my opinion, as a
I
brand
agree.
operator.
I agree, and I've definitely seen, you bring up another good point, which is if you are a brand owner and you have an offer on the table that maybe includes an earnout or a seller note. um, it's sort of touchy feely, but like you need strong chemistry with that acquiring buyer. You need to feel like you want to work with them. They see running your business the same way you did, and you feel like you can be a business partner to that acquirer for an extended period of time. I've definitely seen instances where there's butting heads between seller and buyer, and it ends up hurting both parties. Right, the seller doesn't achieve their earnout target, so they don't you know unlock additional tranches of payment, and then the buyer doesn't know how to stabilize the business. So I say cultural fit is like super important for any of these like variable upside type structures.
Now let's kind of flip the edge from the seller perspective, building a brand. What if you're a brand operator, you're looking to grow your business through acquisition?
Hmm.
What are some tips that you have on the acquisitions space in terms of finding the right business, kind of merging them into your own business?
Right.
Any kind of red flags or
Yeah.
cliffs to look out for?
Yeah, yeah, I think overall, I have like one major piece of advice from an acquisitions perspective, and it's my co-founder and I, Kyle and I, say this phrase all the time: businesses are bought, not sold. So what that means is you want to buy a business where the seller doesn't really need to sell, but you approach them with terms and a cultural fit that resonates with them, and they say, "Huh, I hadn't thought of that, but yeah, absolutely, I would consider selling." Right? I think someone who has raised their hand and is looking to fire sell a business because of a decline, because of an existential threat, a distribution risk we don't know, it can be like catching a falling knife, and you have to be really, really careful and really, really good at turnaround situations if you're looking at businesses like that. But my advice is, as a buyer, look for the brands that are not listed for sale anywhere, that are saying, you know what, opportunistically, I will consider a buyer if they approach me and give me what I want, but I don't need to sell. Right? I'm perfectly happy. I love my job. The cash flow is amazing. No threats to this business. Those are the types of businesses you want to buy as an acquirer.
Okay, so you want to buy them, but the people don't want to sell them. So I would imagine in that you're kind of in a negotiating disadvantage. So
You
I
are.
would imagine you should set the expectations for a higher end for acquiring those companies. Is that what you're saying? Or
Of course, valuation is like the $1 million question. I think in a lot of cases, money is important, but not the most important thing to a founder who's succeeding already. So you've probably heard of in real estate, you know, people will find a house that they love. The sellers will have multiple offers, let's say, for that house, and the buyers will write like, some heartfelt letter with photos of their family and details about like how they're going to care for the house to try to get the seller to move. There's something analogous that happens in an M&A. And so this is the part of this process that's like very much art and not science. The seller, even if they don't need to sell, they will sell to someone they like, who they believe is capable of running their brand and sees their vision. So, taking valuation aside, there's a minimum, let's call it like price to pay to get any seller interested. But above that, assuming that's satisfied, that seller has to really resonate with your philosophy as a buyer, and that's what can get the deal done, and that's what can cause the seller note and the earnout and all these instruments you use to bridge a valuation gap. That's what can kind of set those in motion.
What other red flags should you be concerned with? Obviously, I run my business a certain way. Somebody
Mhm.
buys it, they probably run it a different way. They
True.
like or don't like what I'm doing, but at a certain point, there's going to be like these are kind of major roadblocks. Like, what kind of things should you not be doing that is going to end a deal?
Yeah, I think the first one is I advise sellers sell when your numbers are up. So don't wait for the music to stop playing to sell. You should be taking opportunistic conversations all the time, especially if you have a banner year. So that's one. Don't wait for the curve to crash. And then I think relatedly, because the valuation methodology for one of these smaller brands is a bottom line metric, right? A profitability metric. Overspending on marketing and trying to pump top line, just pump sales while compressing net income, that's actually not going to earn you any premium on valuation. So don't worry about like pumping spend in to make that top line figure pop. And then I'd say that the final piece is this is sort of like a cautionary, put these structures into place earlier rather than later. A buyer doesn't want to walk into a brand and feel like they have to stand up a process from zero, right? They want to see some scaffolding, um, and a system that they can approach and walk into seamlessly, right? So that includes, you know, a 3PL provider. You want someone else doing your pick and pack, your reverse logistics, your regular logistics. To the extent outsourced marketing, a clear playbook for new product development and a product launch calendar. So, codifying all of that and having it in a place where someone can walk up to the brand and say, all right, I understand how to, apportion out the work to vendors is super important.
Yeah. So, from a buyer's perspective, if you're approaching a company that's not for sale in the
Mhm.
marketplace, you think it looks good from the outside, you start the conversations, they have no SOPs, everything's a fire, they're
Yeah.
running around like chickens with their head cut
Right.
off, probably best to walk away from that deal.
Not necessarily walk away, but I think from a buyer's perspective, it reduces the multiple that I'm willing to pay for that business, right? And it takes you closer to sort of the bottom end of the range that I shared, just because I don't know how expensive it's going to be to set up true SOPs, and then also I don't know when I take over, what am I missing, right? Am I going to have a big J curve where uh, top line and net income fall because I don't know the things that are in the founder's head, I can't go replicate immediately, right?
What was the ugliest deal you ever saw get done? Where it's like this person had no business selling this business and this person had no business buying the business.
I'm trying to think. It's a good question. Um, I think there's one brand I can think of where,
Obviously, you don't have to name names of the
yeah.
brands of the deals, but
So normally what happens is um you underwrite cash flow as well as kind of book value. So inventory, asset value, right? Um, I saw one brand where the seller was looking for some multiple on cash flow, and the buyer was only willing to pay a small premium on asset value, right? Inventory value, essentially. And they ended up getting the deal done in between those two metrics. And I think it wasn't ugly, but it was sort of relying on luck more so than, strategy. It just so happened that the buyer was able to um, activate meta marketing in such a way that they could sell through that inventory much more quickly and efficiently than they thought. And so they had a great business on their hands without kind of meaning to. I think that's a fantastic outcome. It's a cautionary tale because that is definitely more the exception than the rule. um,
Like that brand that was selling was just way overstocked with inventory. They just had
Lots of
years of
inventory, and it was unclear. Like you're sinking your money as a buyer into working capital, which is inventory, and what is the highway to liquidate that inventory? Unclear. You're going to have to light a lot of money on fire on Meta and probably other channels to get it out the door. That's always very risky. You can, if you're an expert marketer and you've scaled let's say a brand in a similar category, you might know a playbook and a creative roadmap to get that done. But for folks who are just, sort of like cash flow type investors, that's a hard bet to make.
How much inventory should brands try to keep on their balance sheet?
I would say it varies. So the biggest input to how much you keep on your balance sheet is it's a function of what the rest of your balance sheet looks like, right? Can you front, a large PO charge 3 or 6 months ahead of time without sinking your cash flow to fund OpEx, let's say? And then the other input is how long does it take from a what's it called, a lead time perspective to get that inventory from the manufacturer to your warehouse, right? If it's a short lead time, if I can, place a PO and have the product in my warehouse a month later, maybe a quarter, maybe a little bit more. If it's a 2-3 month lead time, you've got to be sinking a lot of cash into inventory now so that 2 quarters from now, let's say, you're stocked in. So I would say that has a lot to do with how involved it is to manufacture and deliver that product.
Yeah. So no more than 6 months of inventory, depending on how quickly you can get that product
Yeah, what's your cash
into your
conversion
warehouse.
cycle, right? So,
Yeah.
like, if I put $1 into inventory and it takes 3 months to deliver it and manufacture it, and then another 3 months to sell it, that's kind of a slow cycle, right? Like, I would like to put $1 in today and get my, my gross margin back within, 60 days. That's optimistic, but that's kind of the calculus you do as a brand owner.
Yeah. And then what are, in those kind of situations, um, let's say people have a really quick turnaround because they're manufacturing the product. Like, is that
Mhm.
become more of like a red flag or a green flag? Because it is operational complexity.
That's right.
However, you do, have the lower operating cost of
Yeah,
inventory.
true. I would say so from an operational standpoint, if I'm a brand owner, I would probably rather self-manufacture my product because I control, you know, import duties, I control QA, MOQs, like all of that is under my wheelhouse. And if there's defects, I can fix those easily. I would say from an acquirer's perspective, it's complicated to have a deal where the seller is manufacturing their own product because let's say I take over, I buy a beer brand from you, and you're self manufacturing. I have to sign probably some co-manufacturing agreement with you where you're the key point of failure to manufacture my product that I sell, and you're the seller as well, right? You're not a third party like a 3PL. So, not impossible at all to do a deal like that. It's just a little bit more difficult, and it makes the focus on that seller buyer relationship even more important.
Okay. So, kind of going back to what you said earlier, the less kind of overhead
Hmm.
you have generally is going to be better, especially for smaller businesses that are focused on discretionary
Exactly.
income.
Yeah. Exactly.
However, does that game change at all at, the 50 million, $100 million level?
Definitely. Um, and I think a lot of it is acquirer profile too. If you're, let's say, you guys sell to L'Oreal, let's say, that has a massive balance sheet, massive distribution, international presence, right? That acquirer can look at your working capital need and probably just front the cash, regardless of, if it takes a year to sell or 3 months to sell, they can just put that cash down. So I would say the sensitivity to working capital as part of the deal starts to fade as you get higher and higher up the revenue and EBITDA, thresholds. Um, as you're on the low end, let's call it, half a million, $1 million of EBITDA. cash flow is just going to be very sensitive to those inventory decisions, right? So if I accidentally overstock, um, and I have a bunch of essentially static inventory sitting in my warehouse, that can sink my free cash flow for that quarter and like turn me negative, very quickly. So that the tolerance, I would say, for error is a lot smaller when someone's acquiring a smaller revenue and EBITDA brand compared to a much larger scale brand.
Going back to finding these brands, obviously, you're probably going to be a little bit biased with this. Uh, is there any advantage to approaching these brands directly as an operator? So let's say I own Beard Brand, I see another beard care company
Mhm,
out
mhm.
there that I want to buy. Does it just make sense for me to email them, or I mean, you're going to say it's better to go through a broker, I would imagine, but
You know,
walk me through.
yeah, it's a good question. I think if you can get a deal done without a broker and you are, let's say, you're a beard brand acquiring another beard brand, you've got some reputation and industry knowledge that probably matter to that seller a lot. So I say power to you. If you can go direct to a seller and get them to agree to terms, go for it. I think that is fantastic. I would say it's rare that happens. It takes a special type of buyer and seller to make that deal happen. I think the value of a platform like BizPort is we can help level set on norms and precedents as to how do you handle working capital? How do you handle valuation? What does an LOI look like? What's a standard diligence timeline and checklist in terms of pulling back the curtain on what the brand is actually doing under the hood? But not to say it couldn't be done outside of someone like us. We just kind of reduce some of that friction and help the seller and the buyer have a meeting of minds. So
What does that cost working with a
uh,
third party like you guys?
yeah, so we are just a flat fee paid upon successful close of 6%. So 6% of the deal price, if we find you a buyer as a seller, is owed to us as a commission.
Yeah, so it's a commission infrastructure. I'm going to go on a little rant. I kind of hate that. There's
Yeah.
something just like if you've been building a business for years and years and years, you've had business partners. You're like the 6% commission is also effectively like a 6% ownership of the company.
In some ways, yeah, you're right. Yep.
And you look at it from, obviously it depends on the size of the deal. 6% and $10 million, $600,000 is a lot of money. And it's
Yeah.
like, well, could I hire somebody for $600,000 and what kind of deal could they get in house? Like,
Mhm.
do you see any kind of opportunity in the marketplace for these facilitators to move away from a commission based structure and basically, pay for their time and the work they're doing?
Yeah, actually, yes. A retained model would be great for BizPort, I think, right? Because as opposed to working for 3 months, hoping for a close that is a big, cash payout, we could have much smoother cash flow every month and kind of project out the business more easily. I think the feedback we've gotten from sellers is similar to what you're saying, where it's like, okay, there's a commission paid upon close. It can be material, and so that's something to think about. But at least the incentives are aligned. And if you think about it another way, we do a lot of work prepping the materials, the sim, the financials in such a way that a buyer knows how to digest that information and do a real diligence process on a brand. And the decision to for a founder to make is, will my brand be worth 6% more with this buttoned up process than if I were to run it myself? If you do believe that it's going to be worth at least 6% more, we're actually paying for ourselves, right?
Yeah.
And so there is a world where it's cost neutral, if not beneficial to the founder.
Yeah. I mean, like at the end of the day, it's kind of like you said, a number thing. It's like, here's what I'm looking to get. Let's say I want to get $10 million for it, but if you get
Mhm.
it for, 11 million or anything above that, I'll pay you the difference.
Exactly.
Um,
Yeah. Yeah. So that's how to think about it. And if we do access, let's say, another turn of discretionary earnings, right, in terms of valuation, um, that is probably going to be larger than our the 6% you're paying. in terms of your take home. So,
Yeah.
but
Do
it's up
do
to
you
each.
see anyone come in with like unique deals like that where they're just like, I want to pay you more for higher upside, or are most things pretty standard with just a
Yeah.
flat commission?
Most are pretty standard with a flat commission. I think that's because a lot of the sellers we deal with are the opportunistic type seller that I mentioned earlier, where they're not necessarily looking to sell immediately. If they don't sell for another year, it's totally fine. They'd rather just, put this out of their mind and have us handle it from A to Z. And if someone comes along at the terms they like, we're paid easily with a it's a simple structure. That might change for someone who's more of like I'm raising my hand. I want to sell in 3 months. I want this valuation and I want you to pay for yourself. Not something we've come across yet, though.
Cool. Where can people follow you, reach out to you?
LinkedIn is great. I'm also Frank at biz-port.com. I respond to emails really promptly. LinkedIn is great. And then also our site is biz-port.com. You can submit an inquiry as a seller to create a listing and also register as one of our buyers in the system pretty easily there.
You got to get on X, man.
I
That's where all
know.
the fun's
I
at.
know. I feel like it's a
LinkedIn.
black hole, but you're right.
Frank, it was fun having you on. It was good kind of getting in the weeds a little bit with the buyer and seller side. Hopefully deal flows start, I don't know, what do you say, they're picking up? Is it getting high?
It is. And the reason
Okay.
is Q4 is, in the recent memory. And so everybody's numbers are looking great. And folks are thinking about, what would it look like? What would an offer look like today when the history looks this good?
Yeah. So hopefully if you're looking at selling, making a little bit of money, taking your earnings, actually I've been on X. I'm going to wrap it up with this. On X, Sean Frank is the runner of Ridge. And he kind of talks about, depending on your situation, let's say you've been lean for a long period of time, you've been putting all your money back into the business. If you have life-changing money come your way, it makes sense to take it.
Mm-hmm.
Now, if you've been taking earnings from your business for a long period of time, you've got a ton of cash in the bank account, then you can be a little choosy. But don't, and I'll be the first to speak from this, like things can change pretty rapidly in business. Things that seem like they're automatic, seem like they're always going to go up and to the right,
Yes.
can stop going up and to the right, and they cannot go, down and to the right, I guess. Everything's always going to the right. But, so like, the future is uncertain, and a selling opportunity is a way to de-risk yourself from the future. So with that, thanks for listening. This has been another e-commerce conversations. Cheers.
Thank you.
Keep on growing.